Welcome to Mergerbus and continuing our M&A tax course. Today we are going to learn about structuring. Structuring is probably the most interesting part of M&A tax and is one of the things that requires the most creative solutions or uh, most use of your brain to find answers. So let's begin. What are the reasons for structuring? So structuring are generally done for two major reasons. Either it is legal reason or commercial reasons. Now, commercial reasons could be the way the deal has to be structured or the way you need to invest or there are some commercial benefits of a deal. Whereas the legal reasons are mostly the reason for structuring. So if you are going to invest into a company, you can directly simply do the investment, but you do a structuring in a way that could maybe allow you to do it in compliance of some of the laws or is beneficial from a tax perspective today or in the future. So from legal laws other than tax, you would require to evaluate FEMA, SEBI Acts and Companies Act in India. So, what are the commercial reasons for structuring? So, they are have divided into five major reasons for the commercial reasons for structuring. So, first one is control of company. Now, what happens in startups is the founders do not invest a lot of money themselves, but after a few time when they raise money from investors, the investors would invest a large sum of money, which could end up giving the control of the company to investors, which is not what either the founders or the investors would want. They both would want founder to have the control over the company while investors just sort of guide the company. So there can be a way to structure the deal so that the control remains with the founders while the investor put in the money. The second could be a fixed return that is a requirement of an investor that he wants minimum this much return in a company. Then third could be a duration of funding. For example, the investor invests but says I would want to exit after a set period of time, or you need a short-term funding and then there is going to be a bigger event. So in anticipation of that event, you are raising the funds. Then another interesting way of for structuring is benefits to the founder. So this is something that happens around when the company has become successful and now the founders want something extra or compensation from other shareholders for the success of the company. And then the last reason is in structuring today so that you can have a easier exit tomorrow or you are able to repatriate funds tomorrow. So, how to think in structuring? So, first of all, you need to understand what is the objective of this structuring, what you're trying to achieve, what is the main purpose that you want. Then, second, you analyze the existing structure or the existing option that you have and how you can change or structure this to achieve the objective. Then, third, whatever you analyze, whatever you come up with, you evaluate whether it's permissible under the laws, especially under if you are investing in India from outside then under FEMA Companies Act. Because something can be better for taxation or achieve commercial objectives, but if it is not compliant with the law, it cannot be done. Then you evaluate taxes. And again, the best possible solution would be that it requires no taxes. But sometimes people would be willing to pay taxes if it is satisfying the law and is achieving the objectives. This is why the commercial objective and other law compliances are a bit more important than taxes. Oh, but of course, they would not want to pay taxes if possible. And then identify creative solution to achieve all these four parameters. So now let's think of some examples in structuring. So first of all, example was that there is a founder who started the company and had raised multiple series of investment. Now the founders agreed with the investment that they would get a benefit in terms of shares of the company if a target valuation is achieved, and that percentage that they will get extra would depend upon how much their valuation target they achieve. So for let's say if the target is 100, they get 1%. If they achieve 200 or 2x the current valuation, they get 2%. If they do 3x, they get 3%. So this is how the commercials were. But the another important thing was that the benefit would only be provided by the existing investors. So that company was going to raise another series of funds from new investors. Those investors would not be providing this extra shareholding to the founders. So what solution we did? We did a change of terms of the existing investors such that the founders would get the desired stake if the target valuations are achieved. The second example was a repat and non-repat. So there was a tech company that was started in around 20 years ago, and it was started with nominal capital and became a huge company with multiple subsidiaries outside India. The shares were held by founders who were residents when they started, but they moved out of India after few years, and now they were selling this company to PE funds. They wanted to create a holding company in which the founders and investors would own shares so that the new in so what would happen was founders were not selling 100% of the company. They would still keep a minority stake in the company, so they wanted that minority stake to be non to be repatriable so that they can take their money out of India. So what was the solution? The founders created a company with nominated capital. Investor invested money into that company in the desired ratio, and then the holding company bought the shares from the founders for cash, and the rest was put in debt. So we understand it from a numerical example. So the total business FMV of the business company was 700. The holding company had 10, which was the nominal capital invested by the investors. Now the investor put in equity of 23.33 to get the desired stake that they had agreed with the founders, and they put in premium of 501.67. So 501 plus 23 is 525. 525 by 700 is what stake they needed in the business, and the rest of their money was put in as debt, which allowed them to repatriate with interest after some time, so that they got the whole 700 into the business. Now, why this was successful? So, if you would see the holding company, the investment was done at a premium. If it was done in 2020 or 24, then there would have been a challenge under 56 to 7B. But it deal was done after the budget of 2024, and 56 to 7B was no longer in force. Plus, there were other factors also, which would mean that 56 to 7B would not have been applicable on this. Will can you let me know what could those reasons have been? And there were no adverse implications under 56 to 10 because the shares were transferred at a value higher than FMP. So before we leave, think of what other factors that could cause a requirement for structuring and let me know in the comments below. Thanks for watching.